Good afternoon, this is Sean Golding with Golding & Golding, here to discuss the basics of a listed transaction under the larger perspective of a reportable transaction in Form 8886. This is just a brief introduction. Listed transactions are becoming more common, especially with the syndicated conservation easement and the litigation going on. So the idea behind a listed transaction, for example, is the IRS really isn't buying what you're selling, no matter how good you are selling it, right? They think whatever tax strategy you're using is not necessarily kosher. They think it's the same or similar to a tax avoidance transaction that they've already deemed that way and something they may not agree with. The IRS publishes a list. The most recent addition to the list is the conservation easement. The idea behind that is this. U.S. investors, let's say, or U.S. persons, they have the form an LLC maybe or an S Corp, so it flows through. They invest with a promoter or the like who says, hey, we're going to purchase this easement. We're going to completely jack up the appraisal, and then we're going to donate it, and then all you investors are going to take a charitable donation deduction, and since it's flow through, it's going to run through to your schedule a tax return. You're going to save a bundle of money. As you can imagine, the IRS doesn't really like this, and hence listed transaction and reportable transaction rules. The Form 8886 is used to identify listed transactions, confidential transactions, things that are similar. You generally have to identify it as a listed transaction on this form or request a ruling whether you have to or don't have to. The reporting is where it gets kind of intense for taxpayers because oftentimes when they invested, they didn't know it was a reportable transaction. When you're doing this form, you have to specify the type of transaction. You have to identify where payment is, where the payment was made in order to engage in the investment, the type of tax treatment expected, foreign entity information, things of that nature. The idea, most people don't want to provide that information, especially when they're doing something they may consider a bit of a dodgy transaction. So it's something to try to consider beforehand, because by the time you realize that you're in one of these and you want to unwind it, a tax return filing will occur. So then you have to report it. If you don't, there could be penalties. So you file it with the return. Penalty is generally 75%, up to 75% of a reduction of the tax benefit with a minimum of $5,000. Typically, the penalty cap is $10,000, $50,000 for corporations. Listed transactions are different, right? The IRS hates listed transactions, so it's actually 100,000 individuals, 200,000 non-individuals like entities, corporations, things of that nature. If you're out of compliance and you want to get into compliance, there's various programs you could do. There's voluntary disclosure program, VDP, if you're willful, for offshore or domestic. Otherwise, you could do one of the non-willful options. There's the streamline program. Reasonable cause and delinquency are the most common. We have lots of information available on our main website, goldinglawyers.com. You can always reach out and schedule a reduced fee initial consultation if you think it's appropriate. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.